One Up on Wall Street, by Peter Lynch. Section 1. What if the best stock tip you ever received wasn't from a financial advisor, a YouTube channel, or a Wall Street analyst, but from your wife standing in line at a shopping mall? That sounds ridiculous. But that's exactly how Peter Lynch, the man who ran the most successful mutual fund in history, found some of his biggest winners. And here's the part nobody talks about: he genuinely believes you can do the same thing. Not as a hobby. Not, kind of. He means you can beat the professionals. Today we're breaking down One Up on Wall Street, not just what the book says, but what it really means for someone sitting at home right now wondering whether they should even bother investing, or whether the whole game is rigged against them. Stick with me, because by the end of this, you're going to see the stock market completely differently. Section 2, The Problem, Why Most People Lose. Here's a truth that stings a little. Most people who invest in the stock market don't lose because they're stupid. They lose because they've been taught to think about investing the wrong way. They watch the news and panic when markets drop. They buy a stock because a friend told them it was going to the moon. They chase whatever sector is hot right now, crypto, oil, and they sell the moment the price dips and scares them. And then there's the other group. The people who don't invest at all because they think Wall Street is a game only the rich and connected can win. Peter Lynch spent his entire career proving both of these groups wrong. Here's what most people miss: professional fund managers, the people in expensive suits managing billions of dollars, are not free to invest wisely. They're trapped by quarterly performance reviews. They have to answer to committees. They're judged every 3 months, which forces them to think short-term when the real money is made long-term. You don't have that pressure. That's not a small thing. That's actually a massive advantage, and most ordinary investors have no idea they even have it. Lynch's entire book is built on this one rebellious idea. The amateur investor, armed with the right approach, can beat the market. Let's break down exactly how. Section 3, Key Idea Number 1, Invest in what you know. But here's the interesting part, and this is where Lynch genuinely flips conventional wisdom on its head. He doesn't say, hire a financial advisor and trust the experts. He says the opposite. He says, look at your own life. Your job, your shopping habits. Your neighborhood. They're telling you something the analysts in New York haven't figured out yet. Lynch's wife came home one day excited about a new store called Hanes. The product was called legs, hosiery sold in a plastic egg at the grocery store. Women loved it. Lynch paid attention, researched the company, and it became a massive winner in his portfolio. He discovered Dunkin' Donuts the same way, by drinking the coffee. He noticed the lines were always long, the prices were reasonable, and the brand had insane customer loyalty. He researched, he bought, he made money. Now here's my personal take on this, and this is important. Lynch isn't saying, buy whatever you like. He's saying your everyday experiences are data. They're the beginning of an investigation, not the end of one. When you notice a restaurant that's always packed, or a product that all your friends are suddenly using, that's a signal worth following up on. Think about it from your own life. How many times have you used something, loved it, and thought, the company behind this must be doing well, and then never acted on it? That gap between noticing and acting is where ordinary people leave enormous amounts of money on the table. The lesson: your daily life is a stock research lab. Start treating. Section 4, Key Idea Number 2, Know What You Own, the 6 categories. Okay, stay with me here, because this next section is genuinely one of the Most useful frameworks any investor can learn. Lynch says all stocks fall into one of 6 categories. And the mistake most investors make is treating every stock the same way, when in reality, each type needs a completely different mindset. Slow growers are large, old companies that have basically stopped expanding. Think of a utility company. They grow about as fast as the economy, which is to say, not very fast. Lynch wasn't excited about these. You probably won't get rich from them, but they're stable and often pay reliable dividends. Stalwarts are the household names, your Coca-Colas, your Procter & Gamble's. They grow at a decent 10 to 12% a year and won't collapse overnight. Lynch liked these when you bought them at the right price, but he wasn't expecting fireworks. Fast growers, now we're talking. These are Lynch's personal obsession. Small or mid-size companies expanding rapidly, 20 to 25% a year. A restaurant chain moving from 50 locations to 500. A retailer cracking into new cities and markets. These are where 10-baggers are born. But, and this is critical, you need to track them closely, because the moment the growth starts slowing, it's usually time to sell. Cyclicals go up and down with the economy. Car companies, airlines, steel manufacturers. In a recession, they suffer. In a boom, they soar. Timing matters enormously here. Buying Ford stock at the bottom of a recession, before car sales recover, can be spectacularly profitable. Buying at the peak of a boom when everyone loves them can be painful. Turnarounds are companies in serious trouble, maybe near bankruptcy, that might just survive and come back stronger. Lynch made an extraordinary amount of money on Chrysler in the early 1980s when the entire world thought the company was done. It wasn't. The stock went from near zero to multiples of what he paid. High risk, high reward, but you need a very specific reason to believe the turnaround will actually happen. Asset plays are companies sitting on hidden treasure the market hasn't noticed. Maybe they own a piece of land worth far more than the company's stock price implies, or they're holding a cash reserve nobody is paying attention to. These require some digging, but they can be incredibly rewarding. Here's the insight I want you to take away from this section. Most investors buy a stock and just hold it. They never ask, what type of company is this, and am I evaluating it the right way? A fast grower that stops growing is no longer a fast grower, it becomes a stalwart. Or worse. The category changes. Your strategy has to change with it. Section 5, key idea number 3, the numbers that actually tell the truth. But here's the interesting part about Lynch, he's not anti-numbers. He just focuses on the right numbers, not the noisy ones. Forget about daily stock price movements. Forget about what the market did today. Lynch says stock prices in the short term are driven by emotion and noise. In the long term, they follow one thing, earnings. The P/E ratio, price to earnings, is your starting compass. A company trading at a P/E of 15 that grows at 20% per year is cheap. A company trading at a P/E of 50 that grows at 5% per year is dangerously expensive. No matter how exciting the story sounds. Lynch introduced a refinement called the PEG ratio, comparing the P/E to the growth rate. If both numbers are roughly equal, you're paying a fair price. If the growth rate is higher than the P/E, you may have found a genuine bargain. Then there's debt. Lynch was obsessive about this. A company drowning in debt is vulnerable, one bad quarter, one economic slowdown, and it can spiral into bankruptcy. A company with little to no debt and strong cash Reserves can survive almost anything and even grow during downturns by buying weaker competitors cheaply. Here's a real-world analogy to lock this in. Imagine two neighbors. Neighbor A owns a business, has no mortgage, and has 6 months of cash saved. Neighbor B owns a fancier business but is maxed out on loans and one slow month away from disaster. Which business would you rather own a piece of? That's exactly how Lynch looks at company balance sheets. Boring? Maybe. Powerful? Absolutely. And finally, insider buying. When the CEO, CFO, or major board members are buying shares of their own company with their personal money, that is one of the strongest signals an investor can see. These are people who know the company from the inside. When they bet their own money on the future, it's worth paying attention. Section 6, the emotional and psychological angle. Here's where I want to get real with you, because this is the part most book summaries skip over. The reason most people fail at investing has nothing to do with intelligence. It's psychology. Lynch describes it perfectly with the 1987 market crash. In a single day, October 19, 1987, the Dow Jones dropped 508 points. It was the worst single-day crash in modern history. Lynch was playing golf in Ireland when it happened. The phone calls started flooding in. Shareholders were panicking and pulling their money out of his fund. People who had been invested for years were selling at the absolute worst possible moment, locking in their losses forever. What did Lynch do? He analyzed his positions, made a few calculated moves, and mostly held on. Because he understood something most investors don't. The crash was terrifying, but the underlying companies he owned were still the same good businesses they were the week before. Here's the psychological trap Lynch wants you to avoid. We are wired to treat financial pain and physical. Section 7, the 10-bagger, one winner changes everything. This is probably the most motivating idea in the entire book, so pay attention. Lynch coined the term 10-bagger, a stock that grows to 10 times what you originally paid. And his argument is that you don't need to find 10 of them. You don't even need to find 3. You need 1. Here's the math he walks through. Take 10 stocks. 9 of them go nowhere. A couple even lose money. But one of them is a 10-bagger. That single winner doesn't just cover your losses. It transforms your entire portfolio's performance. This is why Lynch says you should always keep some money in the market, always. Be looking, and never sell a great company too early just because you've already made a decent profit. He watched people sell Walmart early because it had already doubled. Those same people watched from the sidelines as it went up another 500%. The real danger isn't holding a 10-bagger too long. The real danger is selling your best idea because a 50% gain made you nervous. Section 7, the 10-bagger, one winner changes everything. This is probably the most motivating idea in the entire book, so pay attention. Lynch coined the term 10-bagger, a stock that grows to 10 times what you originally paid. And his argument is that you don't need to find 10 of them. You don't even need to find 3. You need 1. Here's the math he walks through. Take 10 stocks. 9 of them go nowhere. A couple even lose money. But one of them is a 10-bagger. That single winner doesn't just cover your losses. It transforms your entire portfolio's performance. This is why Lynch says you should always keep some money in the market, always. Be looking, and never sell a great company too early just because you've already made a decent profit. He watched people sell Walmart early because it had already doubled. Those same people watched from the sidelines as it went up another 500%. The real danger isn't holding a 10-bagger too long. The real danger is selling your best idea because a 50% gain made you nervous. Section 8, Conclusion, What this all means for you. Let me bring this all together for you. Peter Lynch wrote One Up on Wall Street as a challenge to ordinary people. His message is not, leave it to the experts. His message is, the experts have weaknesses you don't have. Use that. The 4 core lessons that will stay with you long after you close this book. 1. Your daily life is full of investment signals. When you notice a great product or a business that seems to be everywhere, treat that as the beginning of your research, not a reason to buy. 2. Know what type of company you own. Fast growers, slow growers, cyclicals, turnarounds, each requires a completely different strategy and timeline. 3. Ignore the noise, follow the earnings. Stock prices bounce around daily for irrational reasons. But in the long run, earnings growth is the engine that drives stock prices upward. 4. Your biggest enemy in investing is not the market. It's your own emotional reaction to the market. The investors who win are the ones who stay calm when everyone else is panicking. One last thought from me personally. The world is full of people who spotted the next Starbucks or the next Home Depot, they just never acted on what they saw. Lynch's book exists to close that gap. To give ordinary people the framework and the confidence to trust their own observations and do the work. The next 10-bagger is out there right now. Somebody's already using it. Maybe it's you. Morals. If this summary gave you value, if there was even one idea that made you think differently about money, hit the like button. It genuinely helps this channel reach more people who could use this information. And I want to hear from you in the comments. What's one business or product in your everyday life that you think could be a hidden investment opportunity? Drop it below. Let's think through it together. Subscribe if you're serious about building wealth through knowledge. We break down one great investing book every week, the way schools never taught you to. See you in the next one.